Closing beat, everybody. Happy Wednesday. How you doing out there? Hope you're having a good day. If you like the markets going higher, you're having a good day. Hey, it's a quick show we do. It's called The Closing Beat. We're financial advisors here at Jazz Wealth. We manage long-term retirement accounts, long-term investment accounts. You can check us out on our website if you will, but we just come here every day. We're a small company. We're just out here trying to build credibility, let you know what we do for our customers, and then hopefully teach you something along the way. I've got more to teach today and share with you than ever. So, look, if you're working with an advisor and you just don't know where he's at, or they just don't teach you, they don't help you, they don't try to get you to understand what's going on with your dough, hopefully you'll check us out at Jazz Wealth. We're also playing a game. It's clearly marketing. jazzwealth.com/guess the Dow. We don't market to you, but if you want to take a shot, we'll just ask you who you are, what's your guess you just guess where you think the Dow is going to close, and if you're the closest without going over, we'll send you a $100 gift card. We won't send you any emails or anything like that. We don't sell emails, anything crazy like that. This week, we'll actually announce it on a Monday, because Friday, the stock market is closed for Good Friday, so we'll be closed as well. There'll be no show. And we're also bringing you a Jazz Artist of the Week. Brian Culbertson is your man this week. He's got a song, you got to listen to it like this. You got to look up Back in the Day and So Good, the live version, right? They did it in the studio. You got to see it that way. It's two songs mixed into one, so you get a little bonus here today. Let's talk about the stock market. You got 772 on the Dow. You got an 89 on the S&P, 203 on the NASDAQ there. The markets were higher. Well, they're basically kind of flat to start the day. Then they started moving higher on news that the White House is considering plans to start opening the economy back up slowly. I think there's going to be a lot of little catches there, and still asking you to maybe socially distance around the office and things, but they're working on that. Also, Bernie Sanders dropped out of the Democratic presidential race there. So that came sort of middle of the day. That helped. Obviously, the markets continue higher. They didn't like Bernie Sanders, and neither did healthcare. So that finished higher on the day. We'll cover that. The bottom line here is we are now, there you go, we are now down only 18% from these virus highs. We were down over 30, right? So we've now recovered, 36, we've recovered half of the virus downturn, if you will, from February 19th to March 23rd. That's the date that we used there. Year to date, we're down 14% on the S&P. That's not so bad considering where we were there. And one of the interesting things that happened today, if I can zoom in, we didn't trade under yesterday's low. Yesterday really had that feel of, as we faded away, that, okay, we're going to pull back for a little bit. I mentioned, a lot of the sectors being extended and everything. And so it had that feel, that we were going to just kind of pull back a little bit. But we didn't trade under yesterday's lows, which would have technically triggered the technical traders to believe that we were going to pull back. That'd be sort of their confirmation if you've ever studied technical analysis there. But no, we didn't do it. We actually got a decent amount of news there. We moved back up into that 50% area that we covered yesterday. It's still going to be tough sledding from here. That's my belief. That is one of the rare times I share like an opinion instead of some stats here. I just think this is a tough area. Right in here to about 2,800, you've got a lot of overhead supply which could be coming in. Think of all the people that bought all through the first part of last year, into the end of last year, got excited, invested at the end of the year, maybe invested at the beginning of this year, and then unfortunately had to sit through that decline. Well, when we get back to some of these break-even numbers all the way over here, you're going to have people that are still nervous, that still feel like the world is coming to an end, and they're going to want to sell positions. And because of that, it's going to add a little cap to this rally, which I think some of you are probably hoping for if you were hoping to buy more of a discount or you're kind of scaling in there. Now, as we covered in this class here for you in the dojo, the market recession statistics there and the pullback over here on the right-hand side. These are private classes that we do for our customers. As we covered this, we actually pointed out how recessions perform. We actually went through every single recession and showed you kind of how they perform. And I went through the data to show sharp declines produce sharp rallies, but they're not always the best, like long-term rallies. The sharp declines tend to snap back, and then, it kind of gets to be some tough sledding from there. And so that was in the class. Here's actually one slide from that where we went through a couple of the older recessions just to show in the background there in the gray area, you've got the recession. From start to finish, and you can kind of see some of them that fell sharply. They give you a quick bounce right away. Up here's one of them, down here's one of them, and then they kind of float around a little bit before getting that next rally started. It kind of feels like that's what we're baking in as far as this goes. So sharp declines produce sharp rallies, and then a bit of concern. And that concern could come right in this 50% area if you're going back and looking at, if you're going back and looking at the S&P. This is kind of the area where everybody's saying, okay, this is where we need the economy to get back up and running. We need to see people going back to work. Everybody's getting back to buying stuff, going to Chipotle, sitting there, having lunch and all that stuff. And so I think this is going to be kind of that tough area there. Now, as far as the market on the way up here, what's starting to lead the way? I've mentioned numerous times, I've shown you some slides in the past where we said, okay, look at all the different sectors, and not all of them are going up together, or there's no one standout sector. Well, as far as asset classes, large caps actually are leading the way on the upside there. They held up the best on the downside there, and that was largely due to your mega cap names or your super duper cap names like Microsoft, Facebook, Google, and the like, or Alphabet. Now, on a fundamental basis, the reason for that is because, look, if you're Facebook, people are still using the thing. Maybe some ad revenue dollars come in a little light, but overall, this virus life that we're living through is expected to have a less of an impact on them. If you look down the chart there to small cap, that's the light blue line. These guys obviously can't weather that storm. These are your smaller companies that are more reliant on a healthy economy, and so they have struggled the most. These happen to be our large, mid, and small cap funds that we have here at Jazz. They correlate almost perfectly to the asset classes as they stand, and so whether you're comparing a mutual fund or our funds here, you're going to find about the same thing, that your large caps have outperformed to the upside there. And so we've got that going on, all good there if you want to break that down. As far as the S&P, we've got that 50% retracement. It's still the idea, is the glass half empty or half full? It's becoming harder to tell when you're at the halfway mark, which is where we're at there. On the NASDAQ, you got the same thing. Pointed out yesterday that the red line, or the 200-day moving average, happens to be the 50% area here. So we're getting to the same spot on the NASDAQ. Glass half full, glass half empty. What are we doing here? Analysts also torn. I gave you 2 examples yesterday. I'll give you another one today. Barclays came out. They are officially the most bearish analyst out of the group. They put their S&P target, let's go back over there, to 2,500 from 3,000, which means they are officially the lowest. They have the lowest target by the end of the year. It's about a 6.5%, 7% pullback at this point from here, and that would mean we are down 22% on the year, is what they're expecting. So they don't see this rally as something that's going to be long-lived throughout the remainder of the year. Now, keep in mind, those are end-of-year targets, so that's not like over the next couple days. They're looking back over the rest of the year, to put it there. Bottom line is, if you're looking at the market, you're expecting some tough areas here, some choppiness, maybe a little more volatility, because remember, next week, earnings season starts as well. So you've got a reason for the markets to start sloshing around. So if you've enjoyed the rally there, you try to get your head wrapped around the idea that there's going to be some back and forth. If not, and we keep blasting higher, well, then you're pleasantly surprised. But if you can get your mind sort of thinking that way, then all good. All right, every sector in the S&P 500 today finished positive on the day. Every one of them but the consumer staples sector finished up at least 2% or more. And I've got a chart for you. Here is the current sector recovery by percentages, right? So what we did is we took the virus high to the virus low, and we said, okay, on a percentage basis, which sectors are recovering what percentage of that decline? So healthcare leads the way. It's actually a touch higher here with the end-of-day rally, but here's the 100% mark. So imagine virus high all the way down here to 0, virus low. How much have we recovered since then? We're just over 60% in healthcare. Consumer staples, 57. Technology, about halfway. There's a lot of them, as you can see. Some of the more heavily weighted sectors are about the halfway mark there. Energy lagging behind, and transports as well, with 34 and 35% respectively there. Again, this is from the virus high, which has been determined as February 19th. We all use the same date there, to today, not to the virus low. That is as of today. So we measured from the virus high to the virus low. Then we took how much have we recovered since today. So hopefully that helps you there. Interesting stuff, don't you think, right? Do you like that stuff, or should I just not do? Just show the charts. Retail did well today, up 4% on the day. Pretty much a broad rally. I'll note that Kroger did hold back a little bit, sort of becoming a contrarian play in this sector. If you look at retail, when Kroger's higher, retail's lower. When retail's higher, Kroger is lower, and that's kind of what we've got going on there. A couple other names that stood out. BJ's Wholesale Club was also lower, 3.4% on the day. And Etsy stands out with a decent gain, 7%, back to the 200-day moving average. That there is a 50% rally in 5 days. 50% in 5 days. That's pretty impressive. Over to consumer discretionary there. Up 15% in the last 3 days there. No, sorry, 4 days. Consumer discretionary up 15% in the last 4 days. You've got about 2% or so until you get to that halfway mark. It's about right there if you're looking at it on a chart. So one more good day for consumer discretionary, and it will have erased 50% of the decline there. As we mentioned, Bernie Sanders dropped out of the race there. We talked about it on Outside the Virus today, our Instagram show that we're doing every day. I believe it just went up. We're thinking next week we'll just start doing that on YouTube as well, if you guys want that. What we're talking about there is just things that are going on that are not virus related. You know, other things that are happening. We talked about Levi's today reporting earnings, some Disney news in there as well, just to show what else is going on. You know, it doesn't always make those headlines, so we thought that'd be kind of fun. And so healthcare higher today on the Bernie Sanders news, back to the 200-day moving average, and of course you can see it's performing well. You could also use the chart that I showed you just a minute ago to kind of see the same thing there. All right, moving on. Stocks in the news. You got Zoom still added 3.5% on the day. It's not looking good. They're getting sued a lot for privacy concerns there. And Google came out today and said, hey, if you work for us, you're not allowed to use Zoom, which is, why aren't they using Hangouts? I don't know why they're using Zoom anyways. If you work for Google and you're using Zoom, isn't that sort of a diss kind of there? I don't know. Anyways, you got that. Also, we talked about this on Outside the Virus today. FedEx higher by 8%. Amazon's delivery service, they call it Amazon Shipping, which is where they don't ship from the warehouse. They just go to the business, pick up the product, drop it off at the consumer's place. They're canceling that. And so that helps FedEx because they were the ones that were getting hurt the most by that. So that's in the news. Levi's reported earnings. They beat on earnings, had a good day today, about a 10% gain. McDonald's, well, we'll cover that in a minute there. Yeah, we'll cover McDonald's and Tesla in just a moment. You've got 16% of the S&P 500 above the 50-day moving average. Nice, right? It's getting better and better. 12% yesterday. We were in the low single digits, like 2% for a while. We're now all the way back up to 16% that fast. You've got 2 new highs in the list today. There's some familiar names there. Dollar General hit new highs, been one of the stronger ones through this. And Digital Realty, which we highlighted yesterday, is as far as what they do and how they do things, that hit new 52-week highs as well. All right, interesting chart here to share with you in terms of stocks hitting new 52-week highs. You remember on Monday I said over 50% of the S&P 500 is still 50% or more from hitting new 52-week highs. So on Monday, we had half of the S&P 500 still 50% or further from hitting new 52-week highs. What do we have today? Only 14% of the S&P 500 is within 50% or further from hitting new 52-week highs, meaning it's got 60% to go, 80% to go, whatever. If it's an energy name, it's got more like 80 to 70%, and some of the other names are within 50%. So what we did is just break down a quick little chart to show you. You got 14%, at least 50% to go. You got 0.1%, which is actually over the high. You can't see the line on a chart, it's so small. And 85% of the S&P is within 0 to 49% of making new 52-week highs. That's a sizable change in just a couple days. Gives you an idea of even though volatility is dying down a little bit, there's a lot of action going on under the surface there. All right, I'll make sure I've got one more slide. Okay, wow, we're really cranking today. 0 new lows today. Waste Management is one that is still closest to making new 52-week lows, and Walgreens Boots Alliance as well. However, both of them have at least 10% that they would have to fall to hit new 52-week lows. That's good news there as well. Some of the stocks that we talk about lately that have been affected by the virus. You've got Allegiant. This is an airline company. They say they're burning through $2 to $2.5 million a day thanks to the virus. They've updated their schedules to slow down travel and things like that. Dick's Sporting Goods added 6% on the day. They're furloughing workers as of April 12th. Executives are getting reduced pay as well. That's virus related. Hanes Brands, HBI is the ticker symbol there. Hanes Brands is looking to preserve cash. They're going to furlough employees. They're giving pay cuts across the board there. Not as many names as we've been seeing on this list. McDonald's added 1% on the day. They see international sales have slumped. They're stopping their share buyback. And interestingly enough, their commercials say, hey, you can still come through the drive-thru. You can order online and pick up. And then at the very end of the commercial, it says prices may be higher than being in the restaurant. What? Why? What happened? Why is that the case? Something's changed there. Anyways, Tesla basically flat on the day. Tesla is furloughing all non-essential workers, and they are cutting salaries for those that are sticking around. Not good. PVH adding 2.5% on the day. They are suspending their dividends, suspending their buyback, share buyback that they were doing as a retailer, and they're furloughing their employees here in the U.S. A little late to the game there, but that's what's going on with them. Speaking of dividends, this has been a moving target. Here are a list of companies that very likely, if they haven't already, we've already scratched off some of them, are in trouble for maybe needing to cut their dividend. There's some of the names on there, even though Exxon said they would keep it. You can see some of the names in the space there that they may have even cut by the time we just put this together. But these are companies that have negative cash flows and a reduction in sales or revenue in general that they're expecting. And so we put a little list together just so you could see if you happen to own any of those stocks and you were counting on the dividend, these ones got the warning signs flashing there. You may want to take a look and just keep an eye on the news there. If you're investing, like if you're a retiree and you're investing in something for that yield, if that changes, you may need to move on to something else as long as it makes sense for you. I'm not, of course, telling you what to do, just bringing you some interesting news there. All right, tomorrow, you've got Intuit dividends, 53 cents, and Lincare, I believe, was the other one, 40 cents. I'm not sure, actually. I think that's it, and we have covered it, man. Got a lot to cover today. Let me know in the comments below what you think about the. Do you like some of the extra data stuff, or should we just do what we do and move on? We're just testing stuff, you know. We're just seeing what happens. I know some of you are looking for the S&P to pull back. If you're watching us on YouTube, I'll look through the comments here and see if I can find anything that I can help you with. But we'll go from there. Tandra says, "Is this just a bear market rally and then they sell the rip?" Actually, we're in a new bull market. That doesn't really make headlines right now. It's probably not something people talk about, but technically this is the start of a new bull market. We've done it. We've bounced 20% off lows. As long as we don't go under the low there, will be marked as the start of the new bull market. Yep. There you go. Interesting that comment was blocked, Marcelino. You didn't say anything wrong there, but it is a political comment. That was automatically censored. I do not censor comments here. YouTube does it automatically. Wow. Very curious. Sweet. You like the data stuff? Oh, cool. Oh, look at that. You like learning new stuff. We like putting it together and sharing it with you, of course, because it's stuff that we're studying that as long as I'm not going to get in trouble, it's stuff we can share with you along the way. I like it. Cool. Good stuff. Thank you. Yeah, so all right, love the geeky stats there. We'll continue with that. Do you think May will be a sell in May and go away? Yeah, we've done that study or shared that with you each year going along here. Historically, you got to go with the stats. I'm a numbers guy. I gotta go with the stats there. But I think it depends on how April finishes. And you remember, April is typically a positive month. I've got that one still saved and loaded up here for you. Here's the historical stats on April. I think if this April produces a pullback, right? We've had this nice rally. If we can get one last pullback that scares people into thinking we're making a new low, that sets the tone for probably a decent summer because you're going to have people getting back to work. The kids will be out of school technically. Maybe the paychecks start piling up. People play catch up as you get into the summertime. Maybe that starts to show in the balance sheets of different companies there. So I think it depends on how April finishes if I had to make a bet there. Yep. Do you offer education on derivatives? We have. We've done a few classes on that for customers, just mainly special requests and things, but usually when there's nothing going on in the markets or it's not that exciting, I try to cover different topics like that. I think we've done 2 or 3 different classes on different types of option strategies and things like that, just for people that like looking at that. Not anything that we do here for customers, but for people that like to go out there and play in the market and such. Going above and beyond when it comes to the info. Thank you. I appreciate that there. I love it. Yep. So we've looked into this numerous times, and I'm not just saying this because I want to sell subscriptions to anything. I have no interest in doing that. We can only let customers into the dojo because some of the stuff that I say and the answers that I give are so super specific that it would be breaking what's known as the suitability rule. So I can't say, hey, give me, donate $5 to a charity or something and I'll let you in. If I could, I would have already done that. But so far it is not allowable. Yeah. Do you think some of the financial dividends are at risk? Nope. Now, the reason we came up with that list had to do with negative cash flows, right? So banks don't have that. It's a different metric anyways. But no, I'm not concerned about banks at all, especially the big banks. It's going to take a whole lot worse than what we've seen for them to cut dividends. Not going to happen. Yep. There you go. All right. Well, it seems that I have answered. They may have. If you found a stock on there, like as we were making them, we're like, well, wait a minute, we got to take that one off. We scratched through them. So there may be some on there that have already cut since we've made that chart earlier today. So if I miss something, just know to scratch it off, right? It's a moving target that's moving really quick these days. So people are making adjustments out there. Anyways, I will wrap it up from there. I appreciate you guys coming by, and we'll be back tomorrow to do this all over again. That'll be the last day because Friday, remember, the stock market is closed for Good Friday, so we'll be closed as well. And enjoy the rest of your day. Thanks for coming by, and talk with you soon.
Hey, wait! Before you go watch one of our other great videos, have you had a chance to see our new Fin Tips videos? They focus on one topic at a time, covering investing, personal finance, and anything that can quickly help you with your dough. Best of all, we'll keep it real short, because we know time is money.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.